I'm Jeff Timberell. I'm the director of the Southwest Florida REIA. I am also the broker owner of Stewardbridge Realty, and I'm here to talk about the 2019 market outlook for Lee County, Florida. This presentation and the information was the focus of our January 2019 general meeting. All the data was exported from the MLS and/or public records. It was trended with Microsoft Excel, and otherwise, unless it's stated, the charts contain residential assets. Full disclosure, this was my work done for me and shared with everybody. You got to first, what market are we in today? And everybody wants to compare cycles, this one, last one, what the next one may be, but always remember each cycle varies in depth, duration, and intensity. No two cycles are ever alike. Joke here, this is true 50% of 100% of the time. Market conditions also vary in different markets. Commercial market, the residential market, even the rental market. You've got the differentiation between single family and duplexes and the large multifamily complexes. Another example, commercial in the last cycle trended about 18 months behind the residential market. So it appeared to be a safe haven as the residential market was crashing. In hindsight, all you did was kick the can forward a little bit. So something to think about. Here was the Dow Jones in December. This dominated the news cycle, shook up the economy. It was every day I was logging in and seeing how it started and seeing how it ended. Let's talk about, in my opinion, it was three things. The Wall Street traders were reallocating for a cyclical bear market. I think everybody just finally decided it's time. The underlying drivers of what caused them to do this, the Fed rate hikes have everybody scared. We're very close to the prime lending rate breaking 5.5%. Generally, that is always a recession 9 to 18 months out. And also our leverage structure as a result of the aftermath of 2008 is different than previous cycles, which nobody knows how that's going to play out. You have high frequency trading gone wild, and then the plunge protection team kind of went wild too. Let's talk about the metrics of Lee County 17 versus 18. This is the entire year. It was a great year. You had a 10% growth in volume, 6% growth in sales counts, and your average and median price were both up in the 3.5% to almost 4% range. This, to me, reflects almost just inflation. These metrics remind me a lot of the Midwest markets, just steady growth, not a huge jump in pricing year over year. Let's talk about December. Just like the stock market, the real estate market didn't have the best December. Our volume was down almost 7.56%, and our counts were almost off by 20%. Average price shot up, though. The median went up more than the year-to-date average. Let's talk about year built. This is the entire year. Shows really that here's the two markets where the most buyers are. You've got the current new vintage, and then you've got the 5, 6, 7 vintage, and then everywhere else, it's basically the amount we're built is the amount by percentages to trade. Now let's talk about 18 for December. Across the market was down. It wasn't one particular year built. It was all the year builts essentially that were down. Here's our sales count patterns. Now, almost every year, December has a higher sales count than November. Almost always. It's pretty much a given in my mind. When it's not, it's a reason to pay attention more so. This December, we actually went down from November. Now, that's month over month. Year over year, we were down too. So it's definitely a trend worth watching. With that said, we had an amazing season in relation to 17. So we're going against some pretty good numbers. Bubbles of activity. We do bubble charts. This is a really insightful chart. It kind of shows you where the breadth of the sales counts are. Like if you are trying to work the market where most of the buyers are, you need to be 140 to 290. That's where almost all of the buyers are. Now, December only, it's just like the year built. It's all across the market. It wasn't just one asset class, 1 year built, one price point. It's pretty much everywhere. Particularly the cone of the market was down. Let's talk about year over year. Not a lot of red ink here. Average price went down slightly in Miramar, slightly in the beach, which is insightful because, you know, red tide, blue-green algae, there was a lot of reasons to be pessimistic about waterfront. Now, December, we have a whole lot of red ink everywhere. Fort Myers Beach was interesting. It had a sharp jump in volume and counts, and I think the water cleared up, and I think maybe some sellers lowered their prices. So what else is going on? This chart shows average price since January of '01, shows the last cycle, the bottom, and then the recovery. And if you'll notice on a linear basis, it's really starting to flatten out. What makes the last cycle so different than this cycle was this, it was almost 40% increase in average price in a year, which is wow. If that happens again, get out your '06 playbook. Without that, it's a different kind of correction. But since 2009 shows the floor of the market and then just steady growth, and most of it has been growth back to replacement cost. From 15, it clearly shows it's the price increases are not as aggressive by percentages, and the linear trend line really shows you inflation. Sales counts by property type, the only thing that went down year over year was a townhouse, and that's just because there's not any new inventory coming out in that price point. Pricing by property type, the only one that was down was mid-rise condos, and very, very slight. Our cash sales percentage, we went from 40.06 to 40.22. So leverage isn't a primary change in what's driving the market. It essentially remained the same. The peak of our cash percentage in '09 was 75%, for perspective. Distressed sales percentage, we went from 3.7 to 2.58. The only person that's more lonely than the bank's broker is the Maytag repairman. REO is bank owned, it's real estate owned, and then SS is short sale. When you talk about Gulf Access versus Waterfront, Gulf Access, the percentage of sales counts did go down, which is you would expect given the water quality issues that we had this year. I honestly expected this to be a lot worse. Let's talk about supply and demand. As of the 16th at 2/31, we had 6.11 months inventory for Lee County. 6 months is kind of the break even. At below 6 months, it's considered a seller's market. When you start breaking above 6 months, it's considered a buyer's market. We're sitting right in the middle right now going into season. This is a chart. It's kind of your textbook example of divergence. The black line is the Lee County average price. The red line are the sales counts. And this is the what looks like an EKG is actually our seasonal heartbeat. But this little point right here, it's a really cool lesson. That was divergence to the upside. That was the point where the price came down. You also had demographics in play with the baby boomers. March of '08 was the beginning of baby boomers turning 62. The prices went down significantly. Everything just said, hey, I'll take it. And then it kind of drove out, and now here we are. Let's talk about inventory by city. Lehigh Acres has the lowest with Cape Coral right behind it. Fort Myers, Alva, North Fort Myers, Estero, Bokeelia. Bonita's got 8 months, which tends to be a buyer's market, but Bonita in the last 30 days has really been doing well. By zip code, the Lehigh and Fort Myers zip codes and the Cape ones are doing the best. 4 months inventory in several of them. Now, the distress market update, the negative price pressure from the last cycle was driven by distress sales from banks. These are the mortgage-related list pendants from January of 2015 forward. Linear trend line shows it's going down. This was the disruption due to Irma. This was a resumption after the disruption of Irma. This is a yearly count just to give you perspective on where we are. There's 2018, and there is 2008. So it's definitely not 2008. In closing, I would be skeptical of judging the market based on a real estate agent discussing their production. Most agents first can't see past their own financial status. That's just normal. That's human. But there's a lot of real estate agents right now. There were 7,088 agents that had at least one closing in Lee County, 4,932 that had at least two, 1,143 had 10, And if you had more than 20 closings, you were in the top 345 out of about 9,500 agents. And that's an estimate. I don't have that exact number. Some things to watch going into 2019. 2018 was an amazing year. We had 3 months of more than 2,000 sales counts, and we had a whole lot of months of above 1,500 sales counts. So it was a great year in spite of Irma, in spite of the disruption from Irma. This may be a tough one to top. Another question, do we lack inventory outside the MLS, or do we lack inventory? And this is for new homes. There's 153 homes with a year built of 2017 and newer that were active as of January the 16th. We had sold 843 similar homes in the last 365 days. So if you're looking for a new home, at that point, there was 2.17 months inventory. Chart shows building permits in Cape Coral. Linear trend line shows the growth. And going into 18, we're slightly below the linear trend line for growth. So we're actually going to be lacking some new homes going into season that we probably would have, we would need and would sell. Let's talk about the retiree market. We have discussed this a lot at the REIA meetings, the birth rate chart. If you were born, there's a chance you're going to retire to Florida. If you weren't born, it's 100% you're never going to retire to Florida. Now, there's many ages. There's early retirees, late retirees. One thing we found is trending 62 years of age for retirees tends to correlate our sales counts a lot. With that said, as prices continue to go up, you begin to lock some retirees out because they just can't afford to pay it. So they'll either seasonally rent, step down in their purchase, or just stay up there and take a little vacation to come down here. But when you look at it, we've got great growth coming up, except for the 62. At 62 years of age, which is kind of the new retirees, they really begin to trend off in 2023 with the later retirees coming in. The early retirees tend to have a bigger economic input, or not input, bigger economic effect, and they also tend to have a lot more money. So the older retirees tend to buy more of the entry-level retiree type product. So should the market correct, and this is something to think about, it's been going on for 10 years. It's probably the longest I've found without a correction that I have data for. Now, most corrections are fueled and amplified by unsustainable debt. And something to bear in mind, none of the debt in 04 seemed to be unsustainable to most of the market at the time. So once the market corrects is when it truly fleshes out what is not sustainable. Let's look at commercial. This is from the Federal Reserve. This is the peak of the last cycle. Here we are. So you can say commercial's got a lot more debt than in 2008 when everything corrected or began to correct. Let's look at residential. This is the end of 16. We are just about to pierce the top of the last cycle, but we haven't blown through it like the commercial has. And this is Dodd-Frank. Dodd-Frank has a lot of flaws. In some ways, it's really worked. Some closing thoughts again. 18 was a great year from a statistical perspective. Maybe tough to beat it just because it was so good. In 2016, all the talking heads were calling for a recession 2 years out. So I all said the same thing in 2018. At some point, they're going to be right. We have two different economic trends happening in real estate right now, demographically. You've got the baby boomer generation either in retirement or about to retire. And then you got the millennial Gen Z coming of age. Now, Gen X is in there, but I'm Gen X. There's not enough Gen X. We're kind of sandwiched between these two monster generations. Each one is going to have different and specific impacts on the market, some of which are not known. Many are, because no matter how much we say we'll never be our parents, generally we always end up becoming our parents. Now, this market at this point does not share the same modalities of the 06 crash. If and when a correction happens, without that, particularly that 38% annual jump like we had 4 to 5, the last correction probably shouldn't be your playbook. It's going to be a different intensity and a different duration. And again, December 18 was pretty awful from a statistical point of view. And January 19 appears to be on the same path. I don't know by percentages if it's down as much or not as much. We won't really know that until about February the 10th. But is this a trend, or is just the economy playing wait and see with the macro pictures, trials and tribulations, and then the political picture, particularly with the shutdown? There's a whole lot of question marks in the economy right now. But I can say the last 3 years we have faced similar points, and twice I was ready to call the market, and in 2 months we powered through it. So you really have to wait till the end of season to make a decision on where this is at. If you got questions, you can always call me at the office, 239-694-3300. Appreciate any comments or thoughts. You can call or just leave a comment on the video. Thanks for watching.